Welcome back. The United States added a strong 227,000 jobs in November, bouncing back from a hiring slowdown in October. Wage growth also slightly outpaced forecasts. Let's get some perspective. Joining me now from New York is Thierry Wizman, global FX and rate strategist at Macquarie Group. Thierry, thanks a lot for joining us. We spent a fair bit of time talking about the Canadian jobs numbers this morning. Delighted to have you on the U.S. numbers. What are these? The jobs numbers were largely in line with consensus expectations. What are they telling us about the strength of the U.S. economy?
Well, they're certainly in line insofar as the establishment's non-farm payrolls print coming in at roughly 220,000, which was in line with the consensus about that very level, about 220K. I think if there was anything that was weak in the report, it was coming from the household survey, where we did see a drop of more than 300,000 jobs. That coincided with a decline in the labor force as well, though. And as a result of that, the unemployment rate didn't rise that much, although it did rise a bit. But one can surmise from the increase in the unemployment rate that this was a little bit worse, a little bit of a looser labor market than the market might have anticipated just before the print. And yet, if you think about this, the unemployment rate in the U.S. is still lower at about 4.2, 4.3%, maybe by December, than what the Fed had surmised the unemployment rate would have been back in September for the fourth quarter of this year. So from the Fed's perspective, this is still a tight labor market, certainly tighter than the Fed had anticipated. And yet, despite that, I do think that the Fed is going to cut rates when it meets on December 18th or so. Not by a lot, by 25 basis points. But I think more importantly here, the Fed is also going to signal that the pace of rate cuts is not going to be as sharp as some people might have surmised a few months ago. That's because the disinflation process in the U.S. is slowing down. It is because the labor market's a bit tighter than the Fed might have surmised, but it's also because of all the uncertainty that's coming from the U.S. in view of the post-election environment here. And
how do you expect equity markets to digest that reality, that disinflation is happening at a slower pace than?
Well, look, equity markets like.
Go ahead.
Yeah, I was going to say, well, equity markets do like it when the Fed is not going to be tightening a lot. And the Fed, keep in mind, will continue to loosen. I think to the extent that the labor market is rallying today in the U.S., or futures rallied at the time that the print came out, it was because that slight increase in the unemployment rate made the market think that it was not as tight a labor market as what we were seeing or what they were presuming immediately before the release. But it is a tighter labor market than what the Fed was presuming 3 months ago. Maybe that could account for a little bit of the ambiguity here with regard to the market's reaction.
Will the U.S. dollar, will it continue to rally at a time when the Fed is cutting rates?
Yes, it will. First of all, the Fed is not going to be cutting rates by that much. And even as the Fed cuts rates, the U.S.'s yield advantage will persist well into 2025, certainly against the BOE's bank rate, certainly against the ECB's deposit rate, against the Bank of Canada's overnight rate. As long as those spreads prevail, and as long as the story about American exceptionalism, i.e. higher productivity growth, higher growth overall in the U.S. relative to the rest of the world prevails, the U.S. dollar will stay strong.
Your take on Canada-U.S. relations, economic relations, in the wake of, where I'm going, the threats by Donald Trump of 25% tariffs.
Yeah, look, it's true that Canada depends on the U.S. for a large part of its exports. It's also true that if those tariffs were enacted, it would be very damaging to the Canadian economy. Our view, however, is that a compromise could be reached. And let's also keep in mind that the North America is a duty-free zone at this point. And it is so because of the USMCA treaty, which has the force of law in the United States. It was passed by our Congress. And therefore, if Trump did what he claims he wants to do, this would go to the courts immediately. And I suspect that the courts in the U.S. would serve an injunction on his ability to apply those 25% tariffs. And that means that this is not likely to be as easy as he might surmise it to be. In any case, we don't think it's going to happen in the final analysis. We do think there'll be a compromise. There'll be some concessions by Canada. There'll be some concessions by Mexico as well. And I think Donald Trump will be pleased ultimately with those concessions and will, they'll effectively not need to place those 25% tariffs.
Okay, can we finish with China? I know people in your world are watching China very closely and its efforts to stimulate its domestic economy and by knock-on extension, the effect that would have on the global economy.
Well, look, if China's stimulative policies did have some traction, the best beneficiaries of that, the strongest beneficiaries of that would be Europe, in view of, at least within the developed markets, in view of how much business Europe does still with China. So the problem, of course, is that we have not seen much traction yet from the Chinese data coming off of the stimulus policies that have already been taking place since the better part of this year. Why is that? It's simply because the overhang from the property market and the strained balance sheets among property developers, among borrowers in China, in the property market is still so great, and the wealth effects are still so negative for households that it's been difficult to get the household to spend convincingly. Will it happen? It may not happen. There are reasons to believe that these structural problems are way too embedded in the Chinese economy at this point to make much of a difference, the stimulus that is. And if that's the case, it only speaks to what we discussed earlier, which is that the rest of the world, led by China, will stay slower, at least relative to whatever lofty expectations prevailed at the beginning of this year into next year. And it will allow the U.S. dollar to stay stronger as a result, because the U.S. will stand out.
Thierry Wizman, thanks a great deal.